Hi, everyone. Everyone healthy? Give me a Y. Well, Shahab, everyone doing okay? Gotham, how are you? Sean? Okay. Yesterday's turnaround Tuesday trade worked out quite well. Anyone take it? Talked about shorting S&Ps. There were multiple opportunities to try it around the high yesterday. This one I called it out, and you had several attempts back up at this 40 level, but here we are now. Sean? Okay. All right, good. So I hope some of you guys caught it. That was yesterday. Now what today? So we're approaching some important levels. I believe this was Monday's low right here, and you have the moving average coming in back at this 23% retrace. Okay. And then really the big, really huge level is the 2400 level. Come on, baby. Okay. There. So we start getting through there. Yesterday, I presented a potential option that we could get, kind of a full blown retest and of this wedge line that it broke out of. And as time goes on, it continues to decline. Let's see where it's coming in now. Around 2000 now, 2020. Oh, the year. Okay, so buy the S&Ps at 2020. Yeah, that's something else. Gold that I was talking about. It was very contrary to the a lot of people up here. Almost had a three drive, but I started doing it here, and then showed that we tagged 78.6 here last week, and looks like we've had a successful rejection at the breakdown. Had this blue line in for I don't know a week or so. I actually think that if you want a long-term target, you go to the weekly, a number I've been talking about that people wanted to commit me for up until recently is down here. And that would be some type of fib extension of this wave down. So, here's one or A, or here's two or B, but kind of an ugly weekly chart right here. 2 week off number comes in at 1498. Doesn't look that great to me. And then, what should have done well? What should have done well with the market selling off and gold selling off? What would you think? What instrument, what asset class should have really made hay and, it's making a little, yeah. And really they didn't. So here's TLT. Kind of looks like gold, right? A lot of these things, gold and bonds look fairly similar, right? You had the big break and we got to 78.6 in TLT and the 2 week off numbers all the way down at 159. So, everything is going up together and down together. And yesterday, you couldn't really blame a strong dollar because the dollar came all the way back, but getting euro getting hammered again. So, another pretty ugly week in euro. So, remember, we talked about the monthly, so a lot of euro bears are still looking for 97 and a half. Actually, I think there's going to be a little zigzag on it because when I look at the dollar index here, and it really had a very weak close, closed here, I believe. And we could still squeeze higher up towards 101 and then come off again. But this was the best trade, and it's still looking lousy. And it's a linchpin to everything that's going on right now. Risk. So, you know, this could turn into a full-blown retest. So let me ask you this, people that took this Turnaround Tuesday trade, have you taken a piece of your profits and subscribed? Give me why if you have. Okay. Oh, thank you. Not yet. All the great trade. Not yet. All right. Well, I'm going to block you. Okay. Nice. Nice, Jane. Good, Martin. Okay. Anyway, I just want to say one thing for that I want you guys to think about. And I know we provide this for free. Oh, good for you, Sean. That, it's a reap and sow, reap and sow. You sow, whatever you sow is what you reap. Oh, good, Sean. Mike joined last week. Good. So I know that if you hang out in Face, you get good ideas every day. Steve's reviews give you plenty of things to consider. Blake comes in here, tells you what he's looking for, not only what he did, also very transparent about when things don't go according to plan. And we're open about our losses. Not every pattern in play works as well. But I just want you to consider this. If you're always looking to take, it's going to be very difficult for you to receive. So if you're unwilling to pay people for their good work, I don't think you're going to have an easy time being paid by anyone else because of, just your belief system. So if you're always looking to exploit and get things for free without reciprocation and it's a one-way street, you're going to be on that road alone, on that one-way street. So if you're waiting to do it, boy, you had a great opportunity. I tell you what, anyone who did not take advantage of the offer, that's right. Yeah, you reap what you sow. Okay. All right. Well, that was last year. So we just had a volatility, our special. It's over. If you guys contact Joe Perry today, I bet Joe will work something out with you. So I'm going to have Steve or Blake or someone post Joe's Forex Analytics email. Yeah, it is. It's cheap at 200% of regular prices. Okay, well, that's fine, Mitch. But if you want to learn Forex, this is a good place for you to learn. You go into the chat room and you learn from people that are better than you. So, Joe, maybe you could post it for people in the chat box. All right, just something for you guys to think about. There you go. Joe will probably give you the volatility special that just ended, but it's for today only. I don't want Joe to be barraged. Yeah. Okay. Yeah. I mean, we cover everything, Jane. So just think about it. You have to learn to not only take, you have to give to receive. How many subscribers do we have? 10,000. FX Trader. Yeah. So, we'd like your business, but we just appreciate you coming in here every day trying to harass us. So we appreciate that. So this is for you, FX traders. So if you're always out to harass people, don't expect to be respected. If you can't respect others, don't expect to be respected by others. Okay. Look there's a testimonial. My confidence was at a low point after that massive sell-off, but you, Blake, and the crew has gotten it back. Okay. All right. I'm very emotional today, Blake. I don't know. Maybe it has to do with the surreal thing that we're living through, but I feel better now that I've, ventilated.
Good.
Uh,
Glad you got that out.
yeah, I won't have an ulcer that way. If you keep it in, you end up with, all kinds of health problems. So,
Right, right,
and
right.
it's near our third year anniversary anyway, Blake. So I should get like a pass on anything I say for the next
Yeah.
week or so,
Um,
right?
yeah. So, uh, yeah.
I know.
Okay. So I'm gonna, I'm gonna just bite my lip a little bit here. So as far as the market goes, well, first of all, we have ADP coming up. Equity markets have slid. As I mentioned yesterday, a lot of the buying of the pension buying got done. And I've been short S&Ps since you know above 2600. I've been slightly adding, so I'm staying short equities here. As I mentioned to you guys yesterday, it's we knew about that equity market buying, and it was they did a lot of it already, and they did it throughout the course of earlier last week. And the fact of the matter is the S&P actually held the 38% retracement. Now we got to start watching down here below 2400, because below 2400 then it starts exposing people that are long, they end up getting stopped out. As I've mentioned this to you guys before, and I'll mention to you guys again. I actually had a very good friend of mine. He called me yesterday. I've known him since we were 10 years old. He's part of he's like the chapter regional president of the um is it YEO? No, YPO, Young Presidents Organization. The YPO organizations here in the United States are big, so your business has to do over $1 million, I think, gross revenues annually. And it's they it's a big it's an organization of small business leaders. And he's like a chapter president. He called me up and he's like, hey, I was thinking about, I bought a couple stocks, and he told me what he was buying. And he's like, how do you feel about the market? And I told him what I tell you guys is, ultimately I think the S&P's dropping probably into new lows, and probably between 16 to 1800 level longer term. And he's like, huh, we talked it all out. But the fact of the matter is, I think we're still going to be seeing this, like this area down here, not necessarily today or tomorrow, but over time. And I said, find those companies that you want to own, find the stocks that you really want to buy, and put them on your watch list. And if we start dropping below the recent lows, we get towards 2000, then you got to whip out the shopping list and start looking at the stocks that you really want to own longer term. um, there's a multitude of companies that I really want to buy. There are, and I don't have to list those to you at this point in time, but I think that's sound advice for everybody. And just understand that these markets are probably going to continue to trade heavy. There was an interesting article that came out. It was on CNBC that most individual investors, this is yesterday, hasn't they haven't touched their long term holdings. And frankly, it's going to be a problem for a lot of the baby boomers. You take people that are my parents' age, in their 70s, or in their 60s, or in their maybe late 70s, that have really sought the stock market for the last 10 years for yield, because they've had nowhere else to go. It's not like they can throw money in savings and get some CD that yields them 3%. It's not the case. Excuse me. So a lot of them still have this belief that the stock market is going higher. And you're going to get, unfortunately, you're going to get probably going to end up getting some panic selling from them first. And you got to see that first before stocks are really going to bottom. So like I said, below 2000 in the S&P is going to freak out a lot of people. And that's when people are like, oh my god, how about if the S&P goes from
Blake,
2000 to
good
1000? I
morning.
can't
We have
afford to lose any more of
Blake,
my retirement. Yeah.
we have ADP in 5 seconds, mate.
Oh shoot. Okay,
Yeah.
sorry. Thank you.
Sorry to
Here it
interrupt,
is.
but
What
yeah.
is it? Like I care. I'm sorry. I have to, let's see. Oh, negative 27,000. Okay. It just came out negative 27,000, guys.
Yeah, there it
Sorry.
is.
Sorry, I had to refresh everything. It came out better than expected, but
Yes,
is that going to do anything? I don't know.
I doubt it.
Yeah, I think people are going to look past a lot of this economic data, so don't get too riled up about what you're seeing here. I don't think it's going to be I don't think it should weigh too much on your decision making at this stage in the game, because we know employment's going to be bad, right? We know it's going to be bad, any which way you slice it. So and it's, I mean, in the data that you get right now, it's going to continue to worsen. So anything that you see, um, anything that you see is going to probably get a little worse as time goes on. So anyway, thanks, Steve. Thanks for bringing that up, because I totally was, I knew it was coming out, but I got sidetracked on a little conversation. Anyway, regarding the S&P, I guess the point I was trying to make here is that a lot of the buying was done last week, and a lot of people were expecting that final push. And when I started seeing all the news reports of oh, all this pension buying, this is a very unique situation, stocks are going to move higher, and I'm like, yeah, they're just going to roll over again. So I've been adding to my short exposure and just kind of staying short. Anyway, so the question is, like, what are currencies going to do here? So the euro dollar came under pressure, and remember, everything that the Fed is doing, excuse me, everything that the Fed is doing is intentionally trying to weaken the dollar. They have been fairly unsuccessful at this by this, at this stage in the game. However, without all the actions of the Fed, the euro dollar would be, the euro dollar would be substantially weaker. I think we would see the dollar, much stronger than it currently is right now. So you got to keep that in mind. What I'm gonna be looking at today is the euro, kind of trapped in this pennant. And I think, remember that this is a false breakdown here, just as this was a false breakout. So just understand that this is a false breakdown. This has led to a sharp recovery. Now we're consolidating. I think the risk here is that we continue higher in the euro eventually. And do we hit new highs? I don't know, but will we make another run for those highs? I think it's possible, especially after the false breakdown. So therefore, I think you got to be looking at euro, being long the euro on dips as a result. Now, if we move above 110, I think that's where it turns bullish again. So that's just some food for thought. The cable's actually holding up pretty darn well, I have to admit. 125 is going to be, in my opinion, a pretty big resistance. It is the 618 retracement. I was short a little Aussie, for the last couple of days. I took it off because we came out of this ascending wedge, and it's not really selling off the way that I thought it would. I thought that the Aussie dollar would be already trading well below 60. Again, it's holding up pretty well. So I'm, I pulled it off this morning because I was a little worried that we're going to see a bounce in equities here, and we are seeing a little bit of a bounce. By the way, the Russell is limit down 5% right now. It's trying to come off the lows, but it's still limit down. I still think the S&P today can, probably bounce back to, I don't know, 2550 or so. I think it's entirely possible. So if that happens, then you're going to see a little bit of a bounce in
Russell, Blake, was the one index that was actually showing the underlying weakness, because it was the only one that didn't post a higher high while stocks were still rallying until February. It was the only one.
Yeah, and it's actually limit down right now, and I mean, I look at the S&P futures are down 3.3%. NASDAQ futures down 2.7%. Dow futures down 3.4%. Russell's down 5. Now 4.92. So it's coming off of the limit down, but that limit's been holding it from selling off any further. I still think that that any bounce needs to be sold that you see in equities. Any relatively decent bounce, and right now you're probably going to see like the S&P do one of these. I would assume.
Wow, a month ago we hardly ever said down, and now we're saying limit down. How the world has changed.
Yeah. This is
Who thought a month ago we'd be talking about indices having limit down days, lock limit down?
Yeah, exactly. I know. I wanted to tell you one last thing, which I found really interesting. So the guy that I did talk to last night, he's a very, he's a big Republican, big Trump supporter, and he was in the camp a month ago when I talked to him. Or excuse me, really quick. Sorry. So when he was one of the uh, uh, one of the bigger Trump supporters that I've known over the years, and he was in the camp last month of,
No
this
big
is
deal.
this is a hoax. This
Yeah.
isn't, this isn't real. And everybody's overreacting. Yeah, he's pretty, he is in California, and he is very much
Worried?
Yeah, because he's finally had he had a couple friends, actually family members, cousins, that got COVID-19. So it's interesting to see people's tune change under certain circumstances.
And how unbelievable that a disease should be political. How you look at a disease depends upon whether you're a Democrat or Republican. This is a public health issue, not a political issue. It's just insanity to me, Blake.
It's crazy. It's crazy. Anyway, yeah, I was interested. he had asked me to come to California like he wanted me to speak at one of his events, and this was last month, and I'm like, yeah, I'm not going to be able to do that. And he's like, why, are you scared of the virus thing? And I'm like, yeah, that's a concern. Kind of. I was like, yeah, that's a concern. I also have other things that I can't do it just midweek and take this trip, and I have obligations. And he was just like, but now I had a long conversation with him yesterday. It was very interesting to see his tune change. Okay, so a couple other things I wanted to cover. The dollar Canadian, it's up near pretty key resistance. We had a big rejection yesterday above 143. I cannot believe I bought this dollar Canadian on a dip. I owned it at 140. My average was 140.77. So right here. And I bought some above 141. I bought some down here, and my average is like 140.77. And I don't know how I managed to actually get out without getting my hat handed to me yesterday. But I actually got out for a slight gain, and I was so happy because the volatility was so high. I'm just happy I managed to wiggle myself out of that trade. But anyway, a lot of volatility yesterday during the end of month, end of quarter move. And we're up here challenging resistance. I'm a little skeptical about trying to play the dollar Canadian on the long side here, because we're so close to resistance. But if equities continue to stay weak, then we might actually end up breaking this 143 level, and then that turns the dollar Canadian really bullish again. There's a lot of banks that are actually pretty bullish the dollar Canadian right now. JP Morgan's bullish, Citi's bullish, and they have been bullish since we were at like 141. But it really needs to get above 143 to signal truly a breakout here. So yeah, anyway, I'm keeping my eye on that. And you know, I'm really carefully watching the euro today. I do think that the euro is setting up here. You know, the support's got a hold down here around the 109 level. We do have some options expiring. We have like, I don't know, like 600 million something expiring around 109, and 110 there's like 1 point something billion. Hold on, I'll tell you what it is. Let's see. There we go. 1.9 1.09, 604 million, 110 there's 1.9 billion. So we might, you know, drift higher towards the 110 level as those options expire a little later. So just, you know, think about that as we're down here. You know, there's going to be more propensity for the euro to drift higher than lower from current levels, based on the options expiration. So you're going to, you know, you got people that don't want to pay out as much, so they're going to try to drive price up a little bit further towards the 110 level. That's the risk. It doesn't mean it's going to happen. That's just going to be the risk. But other than that, you know, I think we got a new quarter starting, so it's I'm kind of just getting my bearings straight around, you know, around what's happening, and looking for some good patterns to develop. I think last month, especially the last couple weeks, there was a lot of massive volatility in the FX market, a lot of unprecedented moves, and I think these consolidations that we're seeing are going to develop good chart patterns, and, you know, to give us a better sense of, you know, what direction we should be trading, and we're probably going to get a better feel from a macro standpoint in the coming weeks. So, and I'm excited about that, because the moves last month were good because they were so volatile. It was so, I mean, it was so, but it was almost too erratic, because, you know, when you're seeing 400 pip moves in the Aussie dollar intraday, that's pretty aggressive. It's like the great financial crisis type of aggressive moves that we were seeing. So it's nice to see things calm down.
Yeah, just pull up any March monthly candle in any instrument.
Yeah,
and that's all you have to. There are no words.
Right, you're right.
It's not by accident. We are in a great financial crisis once again.
We are, but it's not as sharp, because this is a moving target. It's you know, we're dealing now with a virus that you know, is really, you know, it continues to develop, and, you know, unfortunately kill people and weaken the economy. But it's not a Lehman Brothers went out of business, oh crap, what's the repercussions? This is oh my God, this is a longer term, you know.
This is everybody's going out of business.
Yeah, it's 1,000 Lehman Brothers.
Hey guys, I gotta take this. My office is contacting me, so I gotta answer them.
Don't worry.
Go, buddy. We got it.
Enjoy, guys. We got it.
All right. Good hunting.
So this equity move was like one of the most predictable, let's say, things. We've been talking about it, right? Almost every day now. We're saying, you know, people have been asking on the chat room. I had some friends saying me, you know, what do you think we sell equities? I said, look, I think really on the first of the month, or if you want to be a little bit more risky, before the close of the 31st. And there you go. So I think, you know, I've said this before. I said it yesterday on the webinar the day before. I think we are heading to 1,800 to 2,000 on the S&P. Where do we go from there is going to depend on a lot of things, but I think we theoretically should be getting there one way or another.
And you know, Stell, I want to validate and acknowledge that you went to cash with your family money and everything well before the sell-off, and grayed out. Do you know how many people wish they had exited when you did?
Well, I did months ago, right? It was like over 6 months ago. So I missed a little bit of the rally in the end, but, you know, who cares about that?
Yeah, but Stelio, reality has shown that there are only two options: either being early or being sorry. There is no third alternative.
Oh, I like that.
People that believe that, you know, there is a magic way to, you know, bottom pick or top pick something.
There is the cursor method.
Yeah,
taught it to all of you guys.
they probably haven't really ever traded real markets. So either being early or being sorry. And
That's a good one.
you were early, and if you ask me, as late as somebody could, be. I mean, I would totally understand if you were much earlier than that, because logic, would indicate that things could have blown up earlier.
Yeah. But anyway, I'm looking for those levels to start going long equities. Obviously not in huge chunks, but I will start looking at some longs. But I think what Blake said is very important. The average retail person is still in it. And I have many friends who are long equities, who have been long for now 10, 15 years, and they're still well in the money, and they're starting to get nervous now. And they're asking me, what do you think? So they actually asked me when the sell-off started, and I said, "Look, I think you should be selling today." And obviously they didn't, and now they're asking again. At 2000,
now that they didn't listen to you the first time, what do you think you should do now?
Yeah,
it's the usual thing,
This reminds me of my parents when I called them in 2008. I was trading in London at the time at Merrill Lynch, and I said, "Look, sell everything, sell the houses, sell everything." And they were like, "What do you mean?" I said, "Look, best case scenario, 50% down. This is a Greek market, obviously." And they just couldn't believe it. And I said, in the end, sell just one flat. They have a few, they have a nice portfolio. I said, just sell one, just for me. And they didn't. And everything went down 50%. And obviously now they listen to me a bit more. But anyway, back to markets. So I think this is the start of a move. It's obviously not going to go in a straight line, but I think we're getting there. We're going to get there in equities. As regarding currencies, with the sell-off, just like we saw a few weeks ago, we theoretically should see dollar strength. It's always happens, when there's a panic, people want the dollar. So I wouldn't be surprised to see the dollar strengthening more, and metals getting sold a little bit, although they've been quite resilient, especially gold.
Much more than in 2008, for sure.
Yes. So that's my broad view for the next week or two, and we see how it goes, because now we're going from one day to the next, and we're seeing what kind of results are we getting from various countries regarding the virus. And China, they seem to be done with it, or close to done with it, if you believe what they say. And we're seeing Europe and now the US greatly increasing cases and deaths, unfortunately. So we've said this before. The market is waiting to see the light at the end of the tunnel. Once they see that, and what the end game is going to be like, more or less, then we're gonna take off. But until then, I don't see what's going to bring the markets higher, unfortunately. And the problem is that we're probably going to have a plateau. Cases are going to start dropping. The summer comes in, and then winter probably going to start again. So that's a problem I'm seeing with markets in general, and with being too early bullish in terms of equities, because this is a thing that's going to cost so much money. It's going to cause so many companies to go bankrupt, unfortunately, people losing their jobs, and of course governments are throwing money at everybody. But this is something that's going to be definitely not we save Lehman, we save Bear Stearns, and that's it. This is not going to be, unfortunately, like that. So that's my view.
I don't know, Stelios, if you heard Gundlach speak
no,
yesterday. I listened to him. Yeah. So in essence, he said the same things we've been saying here. He expects lower, and then the phrase he used, which indirectly he didn't specify it, but for those that know how to interpret economic jargon, I think he thinks the same thing. He said, and then he expects prices, and he was talking about stocks, to move substantially higher nominally. That's
there you go. There you go.
So he didn't, explicitly say it, but in essence he said, I expect things to keep moving lower from here, and I expect that, we'll go higher then, but probably due to inflation. That's why he used the term nominally.
Yeah, makes sense. Because companies, they have real assets, they have, all sorts of things. So if inflation is going higher, stock values have to go higher. It's pure economics and maths. So what else did I have to say? Okay, we had some numbers today. Really, as expected, we had PMIs out of Europe and UK and I think we're getting US manufacturing PMI later today, all in the 40s. So, it's contraction, but
Contractionary
nothing,
territory.
and nothing to go and, jump off a cliff yet, but they're all contracting at the moment. And we're waiting for the jobless claims numbers. They're going to be the ones. Is that tomorrow? I can't remember. Jobless claims. Yes, tomorrow out of the US.
Yes, it is tomorrow.
And that's yeah.
And we have NFPs on Friday.
Yes.
Yeah.
Correct.
Okay. Yeah,
So that's
I'm really curious to see what we're going to get from there.
Pretty much all I had to say. Also, interestingly, you have banks in the UK who are stopping dividend payments, and that's definitely not a good thing to see in terms of the economy. And I remember, I think I read Barclays have said they're not going to pay dividends in 2020, and they were due to pay dividends in something like a week from now, and they said, yeah, that's not happening. So it's not. It wasn't a great development.
Blake mentioned it before, but I didn't want to. I didn't want to interrupt him. He said, a big truth. He said that people were in stocks. Older people were in stocks to collect yield, which shows how perverse things have become. I mean, under a normal economy, you have the ability to safely, as much as safe an investment can be, collect yield by having your money in a bank, by buying some long-term safe haven bonds. But they've distorted the economy so much that people were actually buying bonds to gain from the price appreciation, and they were buying stocks to get a yield, which is, just ridiculous. Now imagine the yield is going to get sucked out of this market. I mean, at a big extent, companies at the very least, they will have to cut down, some of them completely, paying dividends. So that means that people that were just wanting, to make some return so they can live the rest of their life, with whatever money they have accumulated, they will also be forced to either lose that money or to go into riskier investments. And, which means that we're perpetuating the problem by making it even bigger.
Indeed. By the way, Rob is asking what I think of trading the US 10-year now that the Fed is out there buying 650 billion a week. My issue is that if you buy US 10-year, what is it? It's what's the yield on 10-year? 60
There it
basis
is,
points.
I have it here.
60 basis points, right?
60.6
so
basis points at the moment.
If you're a retail trader like I am, like most people are, if you buy that, after commissions, after everything, you're getting very little. So you're buying it only if you think the price is going higher, or if you want something, if you think that this is the safest place to have your money, which I don't want to lend to anybody at 0% or close to. So do I think
you mean negative? Because if we take into account inflation, it's deeply negative, actually.
Yes. And also, I don't want to hold dollars, because after this last squeeze, which we're probably going to have, I think the dollar is going to underperform quite a lot. So I would only buy them if I thought they're going higher, considerably higher, which I don't. So I'm actually short bunds I have been short for a few weeks now, and I think bonds are the risk reward of being long is wrong for me. And if you're right in being long 10-year treasuries, you make a few base points, 10, 20, 30 base points, whatever it is, yeah, fine, great, but the risk is huge on the other side. So I wouldn't want to be long 10-year treasuries. Let me put
Stelio, if I wanted to give a more historical content about bonds, and anyhow I intended to show bonds today on the charts, because we haven't done that the last couple of days. A lot of people perhaps don't know, the older ones don't remember, that this 40-year bond rally actually began at the end of 70s, after the 70s, when in 1971 the dollar went bust. Bretton Woods, in essence, started a huge bear market for the dollar. big inflation spike, and when they had to actually work that out and increase substantially yields to to put a break in inflation, that's what actually started the big bull market in bonds. I'm afraid that we're getting very, very, very close to starting the cycle from the beginning once again. So, in essence, the Fed is now not going to be the buyer of last resort. They're going to end up being, within the next few months, the only buyer. So somebody would say, and I understand the logic. Like, why would you want to fight the Fed? I mean, they're in essence buying, unlimited quantities, as much as needed in essence, of treasuries. So why would you want to go against that? And the answer is yes. Initially and in the short term, it makes sense that why the hell would you want to go against it? But I'll tell you what the end game of this is going to be. The Fed is going to be the only buyer left in this market. So yields are going to remain low until you actually see inflation picking up, and it will. Trust me, it will. With what they're doing now, there is no other option. So
If that guy's
once
looking for a kind of a place to park money, guys, instead of the 10-year, consider 90-day T-bills. You have no principal risk. You're getting about the same interest, and you just keep rolling them.
Exactly.
So that's what you
Yes,
do if you want to just
exactly.
park money. And in
Exactly.
some circumstances, you used to be able to use them for margin. And use those T-bills at a broker in a margin account. So anyway, that's always been the safest paper is T-bills 90-day and keep rolling them. Roll them, roll them, roll them. Keep them doggies rolling. Keep those doggies rolling. Rawhide.
So bottom line, the end of this bond market will be the beginning of the next inflation cycle. And you know something?
Clint
I've
Eastwood
started
was
seeing.
that.
With all the stupid things they're doing at the moment. You start seeing people. I started seeing people tweeting something that within the illogical content that we're within now starts making sense. I mean, if you don't understand the general context, there were people tweeting like, okay, why is the US government still collecting taxes? I mean, if it is okay to create a few $1 trillion out of thin air to support, the banks, the airline companies, etc., I mean, why don't you print a few trillion more so you don't need to collect our taxes? And it's a logical question within an illogical content, because the basis of the question, okay, if it is okay to print $2 trillion, why isn't it okay to print $4 trillion? It's a logical question. Of course, the basis is completely illogical because it's not okay to print $2 trillion. But if you're doing so, it makes sense that some people are going to come out and say, okay, why collect taxes? Then, I mean, if it's okay to print 2 trillion, why isn't it okay to print 4? So why collect taxes at all? I mean, why don't you let us have all our money? Right? So
Or
it
how about,
shows you.
there have been 2 bailouts in 12 years. How about our bailout?
Yeah.
How
So,
about when, the bank was knocking on my door?
and, my comment is going to be completely apolitical because I'm obviously not a Democrat and not a Republican. There are a lot of Republicans that were actually mocking some of the Democratic candidates about wanting MMT. What is exactly happening at the
Yeah,
moment?
that's right.
If this is not what they were asking for, modern monetary theory, I have no idea what it is then, right? Of course, there is nothing modern with this theory. It has been followed several times in the past. The only common thing is the outcome. It has always been hyperinflation and banana republic 101 outcome. And the US would already be there if the US dollar was not a world reserve currency. But they're obviously striving to make it not be so. So the outcome is definite, right? And the questions that people have started asking make sense in the context. So this thing is not going to work, guys. Honestly, I mean, I'm telling you, Stelios can tell you the same thing. I mean, we have no stake in this game. I mean, no matter what we do in our trading accounts is definitely gone, and whatever you guys that listening do is not definitely going to affect, like, liquidity in the system, or how the dollar or gold or whatever else is going to move. But I'm really telling you, I mean, if you know a little bit of financial and economic history, there is no alternative of what the outcome is going to be. So, trade short term what you see and what you like, but really, if you believe that the long term outcome is going to be anything different than it has always been in the past, whenever we were going through periods that they were trying to persuade people that this is normal, it's not going to be, trust me. So having to do with bonds, since we should shift to charts, having to do with bonds, it's more than clear that this move higher so far has corrective characteristics. This is the 10-year yield, by the way. So I wouldn't be surprised to see another low, even a lower low from here. I wouldn't be surprised even, I mean, it's not that weird to expect that, let's fib extend this, to see 0% nominal yield in the 10 years. So let's see. Yeah, you see, I mean, 127% extension is at 0.11. 141 is at minus 2 basis points. Then 161.8 at minus 20 basis
Yeah,
points.
well, at
So,
1800 S&Ps, they should be there.
oh, most likely, yes. I mean,
Yeah.
yeah, if we indeed go to 1800 SPX,
Otherwise, Steve, don't you think
it is
there's
very
a
likely.
don't you think there's a chance that we're kind of digging in our heels for a higher low here and we could get a C?
Might be the case of having an ABC, as you say, but you know something, Dale, if that is to be the case, it has to happen soon.
Right.
I mean, we've
Yeah,
already
like
surpassed
now.
the 61.8.
We're about
And as you see,
78.6.
yeah, exactly.
Yeah.
So,
All right.
and not only that, keep in mind that the 78.6 here is very important because in essence, it coincides with the lower daily close that we had. I mean, we did spike
Okay.
lower, but on the daily, that's the lowest we got.
Okay.
So if that is to be, if this isn't already an ABC, which it is, but it might prove to be a more complex correction. So it might be like an ABC and then a B and then like a 5-wave move up or whatever.
Good or bad from right around in here. So,
yeah, I
risk
mean,
reward, it's not bad if you take a shot.
No, it's not at all. I mean, if you want to take a shot being long here, you have very little risk on the table.
Which would be a short bond position.
Yes, a short bond position, exactly. So if we want to look at the bond itself, here it is. This is ZN. From a technical analysis, I have to say that so far, I mean, this looks like a pennant, an expanding pennant, actually an expanding triangle, a megaphone formation. You can call it whatever you wish. I mean, it's the same thing. Yeah. Looks like we broke above it. So the chances that we're actually headed to new highs from here are high. But yeah, it's exactly what we said. I mean, if you want against the highs to be short here,
that's your stop.
Yeah, that's your stop. Yes, exactly. So you know exactly what you're risking.
Thank you, bro.
Bund, if you look at the Bund,
they're weaker,
the Bund
aren't they?
Yeah, they're definitely
terrible.
weaker. Right?
Yeah. Wow.
I mean, first of all,
Stelios even picked not only the right asset class, but the right geography.
Yeah. Because if you look at it, first of all, we had this big divergence. I mean, the Bund did not post a higher high. Actually, it posted a lower high here. Second of all, so far, this rebound, which it needs to be said, has stalled at the confluence of the 50% fib from this move lower.
They're so much weaker than our 10-year
and the 50 DMA, and just a little bit higher, we have another horizontal support resistance area and the 200 daily moving average. Actually, sorry, I confused them. The 200 is here and the 50 is there. So quite a lot of resistances between 173.40 and 174.20, let's say. So there is a decent chance that the Bunds are going to roll over from somewhere here and move lower. Needless to say that, yes, we're seeing this divergence between the Bunds and the treasuries. And if this divergence persists, that means that it's not going to be that easy for the Euro USD to continue lower or post a lower low. as long as we have this divergence between yields, right? Because this divergence in yields, in essence, supports a higher Euro USD. Of course, that doesn't mean it has to happen immediately. I mean, we've seen periods that, they're not following each other closely, but short periods, because in the longer term, the correlation is very high. Okay, so might be short periods that the correlation is not that high, but in general, if you look in a medium to long-term horizon, the correlation is high. So if this persists, that would support higher prices in Euro USD. Going to sell EuroCAD, your thoughts looking, since we're talking about the Euro, I'm going to take this question first. I just happened to see it was one of the last ones. Listen, now, having to do with the EuroCAD, I'll tell you what my problem with the EuroCAD here is. You have one technical formation that would work in your favor if you're looking to be short, and that is by interpreting this recent consolidation as a diamond formation. You see it here. Let me extend this so you can see it more clearly. Okay. So if this proves to be a diamond formations can be nice reversal formations. Keep in mind that based on theory, a diamond formation can be both a continuation and a reversal formation, but they usually work better, meaning that they produce more follow through if they prove to be reversal formations. Another thing I like about the possibility of this being a diamond formation is the gap. I like the fact that we went into a diamond formation, if that proves to be the case, by gapping higher there. Now, that's the good news if you want to be short. Now, on the other hand, there is nobody that tells us that this is not simply a triangle, right? Or in anyhow a bullish consolidation, because keep in mind that before we produced this, we had broken out from initially from a triangle after falsely breaking down below it. Then we broke above this long-term descending channel. So bottom line, there is no reason to believe that this is going to be a reversal formation. It might as well be a continuation formation. So what I'm trying to say here is don't jump the gun, because this can actually prove to be a continuation formation. What I would do if I was you is that I would wait first for the break to be in the direction you want for lower. And in this case, I would be monitoring this 153 area support. So I would first want to see a move below 153 before I went short. So that's what I think about it. Okay. So that's what I think about EuroCAD. Euro Yen. Let me see. So here is Euro Yen. Now, undeniably, two things can be said about Euro Yen. First of all, it has been in a bearish move since February 2018. You can see it. I mean, you don't need to be any type of an expert. There's a high, a lower high, a lower high, a lower high, a lower high. Probably we just put on a few days ago another lower high there. You can see it. And even if you go back in time, you can see that, we had posted a corrective high in 2014, because you can see why. We had quite an impulsive move lower that started in 2008. Then we retraced part of that. So that was a corrective move higher, most likely moved more impulsively lower. We retraced something like 61.8 of that move. We're moving lower once again. Now, I have to admit that this move lower doesn't look that impulsive, but in any case, as I said, still a series of lower lows. So although I wouldn't enthusiastically buy or sell this pair, it has to be said that, the path of least resistance until proven otherwise remains lower. I was monitoring this channel here. We initially broke above it, so it looked like we might press a little bit higher, but then we collapsed lower once again. So I have to say that I wouldn't be trading this, because I think there are, better looking currency pairs out there. But I wouldn't be long for sure. I can tell you that. Now, if you want to be long, undoubtedly this 116 area is an interesting area of support. So the closer we get to 116, the better your risk reward in attempting to be long. Okay. Yeah, absolutely. I can answer a question on Palladium. I anyhow have a small position short Palladium. And yeah, I'll be more than glad to give you my input. So here is Palladium. To begin with, I shorted a little bit when we had that spike higher. I'm now a little bit out of the money. And I have to be very honest with you. It looks to me that this little consolidation might produce even higher prices before lower. Okay, so I wouldn't find it unlikely to find myself more out of the money. I don't really care because I just have 1/3 of a position to begin with, and I have no problem adding closer to 2,500. Okay, so I think that we might fail from here, or we might fail from a little bit higher, which means 2,500. But I do think that the chances that Palladium will fail once again and produce a sharp leg lower are high. So I still think that there are money to be made being short Palladium. I made quite a nice chunk of money being short the previous time. And, if it is to take a little bit back and I'm wrong here, fine. But I still feel quite comfortable being a little bit short and adding closer to 2,500. So that's my take on it. What is my stop loss? First of all, I very rarely use stop losses in the market, and that's not something I suggest you do, but it's something I do for myself. And why I do that, it's not just because I think I have the experience to handle that, it's because I use very little to no leverage whatsoever. So I wouldn't advocate to anybody not using stop losses. But definitely it's something you can do if you know what you're doing and you don't use leverage. Okay, I'm going to stress it again. Using leverage makes not using stop losses, idiotic whatsoever. Now, my mental stop loss is a daily close above 2,500. Okay, but it will depend because it also has to do about how price action will be evolving. That's another reason I don't like stop losses, because you might put a stop loss in place and it might get hit for all the wrong reasons in a formation that still looks like you're on the right side of the market. And that's why I always use mental stop losses. I mean, I'm not advocating that when you go in a trade you shouldn't have in place exactly where your risk is going to be. But what I'm saying is that part of judging where your risk is also judging the technical structure of the move. Okay, so for me, it's a combination of deciding on a level that I think is important and also seeing if the market confirms when we hit that level, if we ever hit that level, that I have the wrong thesis and I was wrong in what I was thinking about. Okay. So, if I had to in a simplistic way answer, my mental stop loss is I don't want to see a daily close above 2,500, 2,520, let's say. Okay. Yeah, actually, about Palladium, Ben, since you're asking, I'm not doing it because they used to offer a CFD in Palladium in my brokerage firm, but they don't offer it anymore. I'm not trading Palladium myself anymore. I have to do that through the private fund I used to work for. So they do me this favor. They open those positions specifically for me in Palladium. Okay. So I used to do it through CFD, but they don't offer it anymore. So I have to do it through them. So, we're doing it directly through the bank. Okay, let me see, because I for some reason I went from the bottom of the questions and I need to move a little bit back. Gold going down too. I don't know what you mean, gold going down. Gold is holding up quite nicely so far. I mean, yeah, if you mean yesterday was a down day for gold, yeah, yesterday was a down day for gold. But, has gold really gone down? No, I mean, the structure in gold is still quite constructive. So we did breach through this 1585, 1590 area. Another area of support which is quite important is roughly here at 1550. So as I've said, as a short-term trade, I wouldn't be long gold at the moment. But as I've said, I'm not I'm not advocating for anybody to be short gold, because you might wake up one day and find gold being a lot higher than what you left it, and you really don't want that to happen to you. So gold is obviously more or less in a choppy formation here, and I need to see more evidence. And by evidence, so obviously I mean more price action to determine what's happening here. Is it some kind of a triangle? Is it some kind of a corrective move or whatever? But it is what it is. 1550 support, and I wouldn't be jumping the gun being short, as I said. Dale, I finally took some of your pearls of wisdom and joined last week. As a result, I made best 100 I've ever spent, says Sean. Okay, nice to hear that, Sean. I am on here because I have no idea about trading Forex and want to learn what's about. Not sure if trading Forex is for me. Appreciate your service. May join in the future. Yeah, I mean, what I can tell you in advance is that trading Forex is the same thing as trading anything. I mean, the type of discipline you need and the type of rule following you need, I think, is more or less the same, irrespective of if you decide to trade stocks, indices, commodities, FX. I'm not saying that they trade in the exact same way, but I'm saying that if you manage to trade one of them successfully, there is probably no barrier that will prevent you from trading other instruments successfully as well. I don't know if you agree, Dale.
Yeah, it's just a title. The only difference is leverage and beta.
Yeah, more or less. Yeah.
A chart is a chart is a chart.
Yeah, Coach, do we have an interview today?
Yeah, that's why I was.
Okay.
That's your cue now.
Okay. So we have some questions. Eurostocks. I'm going to have a look at Eurostocks tomorrow for you. USD CAD. USD CAD looks bullish to me. About to break through a bull flag. We're going to have a better look at it tomorrow. Although I had a look at it yesterday and nothing has really changed, so I do think it remains bullish. Anyhow, we'll cover the rest tomorrow. Enjoy the interview.
Thanks, Steve. Okay, Richard. Getting you set up now. There you are. Welcome back to Face, Richard.
Good morning. Can you hear me?
Can hear you fine.
Fair, perfect.
How are you? You healthy?
I am now, yes.
All right. Good.
I had a bit of a sickness back in February, actually, which I didn't get tested, but the symptoms were very, very similar to COVID-19, the temperature and the dry cough. So
did you lose your smell?
No, I didn't lose my taste or sense of smell, but I was bedridden for a good 3 or 4 days, couldn't get out of bed, and I was not in a good way. I was messaging friends and telling my wife I've not been this sick in about 20 years, since I was a kid with a really bad flu. So who knows? I don't know whether I had it or not, but it wasn't pleasant. Yeah. I'm okay now. I'm all good.
Good, man. All right. So then you have enough strength to share your screen today?
Absolutely, yeah.
All right, it's that little green box on the drop-down menu.
Okay, there we go.
Corona. Fear that I'll own you.
Over there? Everybody healthy?
Yeah, so far so good. I always feel like I have the flu. So I think they call it
they call it old age. Huh? They call it old age.
They call it, the trading. I used to call it the commodity flu.
I know a really funny guy that was like close to your age actually. When he said it, which he said, when you're above 50 and you wake up in the morning and nothing hurts,
yeah,
that probably means you're dead.
Oh, okay. Oh, I was wondering. Okay. All right. Well, anyway, I must be in hell.
Are you practicing social distancing over there?
Yeah, I am. I'm doing my best to do it. It doesn't really make sense, social distancing, and then you go to the grocery store. I've been ordering my groceries, but then you have people standing right next to each other and getting in lines. It's really confusing here in the U.S. But in the meantime, I do recall the last interview that we had, and there were a couple of bullseyes that you had, Richard. Lower euro was what the option market was telling you. So what's on the docket here? What are we looking
Well,
at?
we can carry on where we left off. We
Okay.
discussed. You can see my screen.
Yeah,
Okay, you can see the
got it.
Australian dollar, US dollar monthly.
Yes.
Perfect. Okay. So yeah, as you recall, we spoke in October 2019, beginning of Q4, and everything was great. We had no COVID. We had everybody was a bull. The stock market was flying high. Everybody thought the Dow was going to 30,000. So it was a very risk on environment, So
right.
Essentially, I was bullish Aussie US dollar and had a target an initial target of 70, which it struck in.
I remember
December,
that call.
just before
That's
Christmas.
right.
Actually, I'll close that trade.
Yeah. Okay.
How things have changed since.
Yeah.
So looking at the monthly Australian dollar, US dollar, obviously we've had, a volatile Q1, the most volatile quarter since the 80s, I believe. Is that right?
I'd say maybe
Or
since
perhaps
the
even ever,
20s, ever.
Yeah.
I think it's ever.
So it's been. So I'm normally a bit of a position trader, swing trader, but I have to confess, over the last couple of months, I've been day trading because the opportunity's been there. And
do you drill? What time frame are you drilling down to day trade? 15 minutes?
10.
Mm-hmm.
Yeah. So I'll start with. I start with a bias on the daily. I'll look. I'll just tell you exactly how it goes. So I'll look for a bias on the daily. What I like to see is where price is relative to. If I just show you, I'll go on the daily. Okay. So where price is relative to these, you can see there's two dotted MAs, the 5 EMA and the 8 MA. What I like to see is where price is relative to those MAs. If it's below, I'm generally bearish. This is obviously day trading, and then if it's trading above, then I'm generally looking for long trades, and then I'll just drill it down on the 4 hour. I like to see the similar situation. I like to see a close below the orange one, which is a 14 EMA, so 2 weeks.
Yeah.
And then I'll just look for an alignment on the 1 hour 30, and the 10 is essentially what I enter in on. Looking for just to pick up maybe 30 pips, 40, 50 pips, something like that, and something that I've been doing over the last few weeks. But it's definitely something that it's mentally exhausting. I mean, you're a day trader. Are you a day trader, Dale?
Yeah, sometimes I scalp. Yeah. You're right. It's a young man's game.
I'm not young.
That's what I mean. It's intense.
Well, actually, one of my he's a friend, but he's also like someone that I mentored. He's come through the swing trading and he's done very well, and he's on like 7 or 8 months consistency on swing trading, and then he's been really eager to get into day trading. So he's been day trading. We've been chatting in the room, and he's had one of his best. I think he had his best single day return last Monday. I won't tell you the figure, but he had a great day. And he was like, "This is fantastic. I want to be a day trader. I don't want to go back to work," because he's in the UK. There's an offer where you can be on what's called furloughed leave, which is essentially you're off work, but you get paid 80%.
Yeah.
So he's doing that, and he's day trading at the minute. He had his best day on a Monday, and then he give it all back on the Tuesday. And he went, "This is insane. This is exhausting." I said, "I told you, it really is. You have to be very careful and keep your risk intact and your psychology intact as well, because I think what he started day trading and had such a confidence from the Monday. He's gone overconfident on the Tuesday, and then he's lost maybe a couple of percent, and then he's just revenge trade and lost a bit more and give it all back. And essentially, that's why I think so many, without going off on too much of a tangent, I think that's why too many newer traders, they want that excitement, they want a day trade, and then they realize quite quickly that it's a very, very difficult game is day trading. And so they go full circle. They'll either quit or they'll revert to swing trading, and then they'll get their consistency up swing trading, and then revert back to the day trading. So
Yeah, I'd trade my best day for this not happening in the world.
you would, sorry, say, can you repeat that?
I'd give up my best trading day of the year for this not to be happening in the world.
Yeah, absolutely. It's not a good situation, and I don't know if it makes it. You know, if there is some silver lining in this great big cloud over the world, is that we're kind of all in it together, and we've all got to get out of it together. And I think that's you know, the solidarity and the focus that's required, to be honest with you. But the world keeps on spinning, and we will all keep improving. And that's all we can do.
Well, you know, I don't know. I don't really think that's human nature. I think the grocery stores say it all. It's, you know, me, and my stockpile, and I don't care if there's anything left for anyone else. So anyway, Lord of the Flies time, buddy. So tell me what you're thinking here with Aussie and risk off and.
Well, what I'm thinking, I am, you know, everything's been flipped, hasn't it? The cycle, the general macro business cycle was already, even last year, you know, the Australian economy was not looking great last summer.
Before this, everything was already, as far as I'm concerned, the fundamental data out of Australia was already turning, and the corona COVID-19 was just a catalyst. So Australian dollar, US dollar, I'll tell you what, I'm just bullish US dollars. And then coupled with that, we've got the weaker currencies, which I'm looking to short. I'm already currently short in Aussie US dollar from yesterday, but that's just essentially like a short swing trade. And then I'll look for possibly a better retracement depending on how the the risk off, risk on sentiment continues through this first few days of the month and the quarter. So I'm looking at Australian dollar, US dollar, Euro, US dollar, and Great British Pound, US dollar. Long dollars. You think Euro, we're going to head towards parity? Do you have any targets?
Absolutely. If I just pull it up, that's so there is the long-term chart of Euro USD. Parity is certainly on the cards. I can see we've got the turquoise one is the 50 MA. We've had this doji monthly, this insanely volatile month. We're heading down, and you can see that it's certainly going to come down and test. Where the problem is this with these currencies, it's a race to the bottom, isn't it? Every central bank is just easing. It's just a race to the bottom, and then you're left with, okay, so what is the flight to quality? And it's just your best bet on the worst outcome for.
That's a hell of a trend line that we're trying to hold. That goes back to 1980, 1980. 85. Wow.
Yeah, and if that goes, I think we're not just going to see parity. I think without going over the doom and gloom of what's happening, economies, the whole globe is shut down and has been static, more or less, give or take. I know there's some key businesses that are running, but this data that we're going to see come out in the next few months from this period, this quarter that we've just had.
Yeah, all through this, when I was reading about deflationary scenarios from bears, I was always thinking about, what would be the financial event to bring it on? And, you could go to debt and, just the fact there's not going to be enough demand for paper to be able to roll it over without rates going up, not because the economy is strong, but just because of supply. But, this shutting down the world, which has never happened in our lifetime, is so deflationary. and what central banks and governments, like the story of your mentee getting 80% of his income, all of these are just such emergency drastic measures that I think the deflation wave is going to be bigger than most people thought it would be because of the lag time. And I have a hard time believing that governments are going to be able to smoothly run a program like this or be able to continue it long enough for for the economy to heal. To me, this is a car wreck, a deflationary car wreck. What do you think?
I'm completely on the same page. I think it's going to be the end game of this. Well, one thing's for certain, that things aren't going to be the same after, a recovery. I mean, there's going to be a recovery of sorts. There has to be,
Yeah.
there has to be. But the deflationary story you're talking about, the wave, the economic fallout it just goes full circle back to the positioning of where I want to be in these currency pairs.
So, I mean, it's interesting. A lot of people had this scenario on this wave they were looking for. And really, I mean, most people, including myself, are looking for financial reasons for it to happen. And there are financial reasons why it's happening. Don't you think it's no matter what they do with paying people salaries and no matter what they do with being able to goose up prices of equities, that we have a massive credit crisis brewing here, and try and repair credit markets, which I interviewed a guy the other day. He had a great expression. He goes, "We don't have capitalism, we have creditism." So if that trigger mechanism is gone, um, you know, how do you repair it? Isn't it just going to take a long time? Like the lost decade is possible?
Look, I think you've hit on a very important point. Economies, despite the industrialization and the manufacturing and the actual output side of things, but consumer-centric economies such as the US and the UK and EU, the human behavior is what drives economies, and that is what you've just said. The credit situation, without people employed, without jobs, with unemployment is going to keep increasing, and with this wave of data that's going to come out, it just said this morning on the news that there's 800,000. I know this in numbers terms relative to our population, this is a lot. I know in the US it's not, but in the UK there is 800,000 businesses that are just a couple of weeks away from going bust.
Yeah,
So-
does the UK have a plan to make grants or forgivable
Well, they've
loans?
put a plan in place. They come out with a very astute offer, which, as far as a government, UK government concerned, it seemed on the broad basis, it seemed quite fair. But there was some grey areas and some areas of concern. So there was interest-free loans. There was universal credit, which is essentially a benefit that people can just sign on and receive. There was VAT deferrals. So all it was, and all it is papering over the cracks and delaying the inevitable, which is what you've just discussed. You've got this situation in the UK, and I'm sure it's very real in the US as well, and the EU, and obviously globally, where you've got, as I say, consumer-centric economies that drive the economy, that they're going to have no money to consume, and then there's going to be no demand, and then and that's where I see the euro dollar, Australian dollar, US dollar, and sterling US dollar. That's where this 1984 or 1985 all the way through to today's trend line, this is where we're going to see, I think, a huge shift, despite what central banks and intervention is going to come into play. It is the human behavior behind the, I know we're talking quite macro and rather than technical.
Well, I want to go to one more macro topic that was on everyone's mind for years and finally happened, was Brexit. Do you think the UK, do you think and everyone was worried about that? It turned out to be pretty much, nothing in comparison to this. You think the UK is better off having gone through and accepted Brexit in the face of this crisis, that they're more on their own and don't have as much interdependence with the EU, or would they have been better off staying in the EU?
Well, there's no better chart to demonstrate what.
And then the pound chart.
There we go. So
yeah,
that, I mean, there. Okay, let's go on the daily. We might see a little bit more of a. Yeah, I mean, there we go. This is what people think of the pound from. So this is the, this is the end of February, beginning of March, where the coronavirus was kind of made national news, and you can see what's happened to the euro versus sterling. Everybody is selling sterling, buying euros. Admittedly, it's I think I measured it. It went up to sort of 4.5 standard deviations away from the mean, and I believe that this is just a pullback. I think we're heading to parity on euro sterling as well. So going back to your question, Brexit, I voted to remain part of the EU because I knew that economically it made sense. Constitutionally, I might not have agreed, but economically it made sense. And now we're on our own, and we're in a really bad position. And now we've got this to deal. So to put it in a sequential process, the UK government put this referendum out in 2016, and then they have been looking the other way, i.e. looking at Brexit for the last, few years. And then now this has come along, and they're going to be looking the other way. Then they've got to come back. So really their eye hasn't been, as I say, in the UK, their eye hasn't been on the ball. They've not been doing what they're supposed to be doing, which is, essentially focusing on generating revenue out of, and creating an economy that is sustainable. So to see that again, it just reinforces my conviction that sterling dollar is going euro dollar.
Give me a number. 80 cents.
Let's have a look. Okay, so I mean, it's an ugly chart. I mean, it's just been trending down anyway, but we're I'd say sub parity.
Okay, everything heading towards parity, or under.
Or I'd say possibly under. I mean, you can see the way it's dancing along. 120 at the minute. It has done. Sorry.
All kinds of measured moves would take it to
it's just
20 cents if you go up to $2. Anyway, diversify your currency over there, buddy.
Absolutely.
Okay, so anything else on your radar you want to talk about? Otherwise, you could perhaps show your website and the services you offer, Richard.
All I would say is to be extremely careful out there. If you're a newer trader, I've been trading the markets for over a decade. All I would share is to keep your wrists tight, stay on the sidelines if you don't know what you're doing, because this volatility and the way that news travels and the way the swings in the equity and the indices is just insane. It's insanity. It's the way that the sensational.
I'd like to wrap it up with, we were looking at bonds, U.S. and the bonds have a weaker structure than the 10-year notes do in the U.S. What the gilts look like?
Well, the yields.
I mean, you have a view on rates. Are they heading up in the UK like the bonds are heading up?
Well, yields are, I think yields are going to zero. I think it's
zero. Okay.
Yeah, same as the US. I think the 10 years is going to zero. I think.
Okay.
That's my view. So.
Okay.
It's been a pleasure to talk to you again.
All right, Richard. Thank you so much for coming on. I hope you have immunity now from, maybe you did have it.
I'm just practicing the social distancing, and hopefully I can remain healthy until this is all over. And
Well,
I
this
wish
is
you all
my
the best as well.
this is my hope for you and your loved ones and everyone listening to this interview, that you and your loved ones remain untouched.
Likewise,
And
back at you.
and with that being said, I want to thank everyone for hanging with us today. Remember, don't just count your pips, count your blessings. And we'll see everyone tomorrow. Good hunting. Thanks again, Richard. Take
Thank
care,
you, Dale.
buddy. My
Bye for
trading warrior brother, Richard Seeley. Talk to you later.
Thank you. Bye-bye.
You're welcome, guys. Adios.